Thank you very much. So, infrastructure, innovation, and a long-term vision. This might be, the elements for a recipe. And a financial system that is back to financing the real economy and public works. All of this has to be done with the public budgets, which are very heavily under pressure. The demand for infrastructure in the world is going to be huge in the next decades. We've seen Brazil, the needs for Brazil. We know the needs of the Eurasiatic area. We know Africa, China, India. So the demand is going to be huge, and also the ways to finance different national or regional systems are probably going to be different. I've been concentrated quite a bit on Europe, of course, and we have an interesting model or history to show, because we've been trying to build the networks for energy, for transport, for telecommunication all together for the since Second World War, probably, and we are now in some serious troubles because we have very high public debts and public deficits, and about 2/3 of our public expenditure is social expenditure. And we heard yesterday that welfare states are a wonderful thing, and we should export welfare states all over the world. But of course, that leaves very tiny resources to finance investments. That's probably not true for other countries which have, higher growth rates, and they can probably afford to put public money into infrastructure, because infrastructure need public money. At least in the first phase, and the more technology we need, because we need more technology, because if we are going to make it in this world, in the future, in the 21st century, with the pressure, with this huge convergence process of more than 2/3 of the world economies which are converging on the growth rates which we had in the Second World War, and this is going to put a tremendous pressure on the world, on the environment, on the political stability of the world, and we don't have a central government, we don't have a way. Things are just happening, and we are here trying to think what to do and what not to do, changing paradigms. But then Professor Greenberg was very right. We are not going to change things from one day to another. We are not going to move from a dollar-centric to a multi-value, and we are not. Things take time, and unless we have breakthroughs or revolutions, but we don't want to have too much revolutions here, because otherwise the things are going to blow up. And the time of history is going faster and faster, and different times. Finance is going faster than everybody else, and institutional buildings go slower. We've seen the spring in the Arab countries. You cannot think of moving democracy from one decade to another. It takes time, and so this asynchronicity of times is what worries me a lot. The risk is to break the clock of the world somehow. But if we're going to make it, we're going to make it because innovation, technology, and infrastructure. There's no question. The people who died in the Mediterranean seas died because they didn't have enough infrastructure there. But infrastructure and technology is expensive. And the idea that infrastructure do pay themselves with cash flows completely is something that we are exploring a lot, and we're trying to do, but it's not completely true. We need also some public money, we need new financial instruments, we need financial engineering, but not the type of financial engineering we had to build structured finance or subprimes. We need financial engineering that is going with guarantee schemes, with partial public contributions, with long-term investment, with accounting rules, mark-to-market accounting rules. It's terrible. So, you have to value your assets at any moment in time, when there are assets that can be valued in longer periods of time. And that changes, because the devil is in the details. So a number of very complicated technical mechanisms can help to build up schemes that allow building for infrastructure that partly pay for themselves. There are about $90 trillion of institutional investors, long-term investors, pension funds, insurance companies, sovereign wealth funds, endowment funds. They are investing now. They're investing mostly in sovereign bonds of German or T-bonds. And if they invest 2% in infrastructure, they have long-term liabilities. So assets, so they might have liabilities, so they might have long-term assets. They like long-term assets which will have a stable cash yield, 1 or 2% over inflation. And many of the infrastructure projects can provide that kind of cash flows. So if they invest now 2%, they invested only 10% of their total assets, we will have a huge amount of money to finance the huge infrastructure projects that we are talking about. So there are elements to be optimistic. There's a lot of work to be done. Share experiences. Have a long-term view. Go back to long-term investments. There is no question that the crisis was the effect of short-termism. Too much money, too much arbitrage possibility. Of course, if I have a lot of money, of course I don't, but of course a banker has a lot of money, can move money from one place to another and make money with money. Why should he try or she try to put the money in the real economy when it's more costly, more risky, and blah, blah, blah. So we have to go back to give incentives to those financial markets because they exist. They're gonna leave us forever. We're not just gonna go in a completely new model. So we have to give strong incentives, rules, policies, incentives, and a lot of technical capacities, and putting together engineers, scientists in technology, together with engineers and scientists in finance, could be a very good combination. Okay, thank you very much.